Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The market's reaction to FUBO TV Inc., that's ticker FUBO, it's really a textbook case right now of a structural transformation just meeting extreme volatility. It's a compelling drama, I think, playing out because the company has fundamentally reshaped its business model. Yet the market is just deeply divided on what that new reality actually means for the stock.
It really is. And the last price action is just, it's defined by conflict. And the volume data absolutely supports this tension. We're seeing extremely high conviction on the bearish side. The total short interest is stubbornly high. It's estimated between 64.5 million and 68.6 million shares. That is a massive 19 to 20% of the float. And critically, if you look at the days to cover ratio, it's hovering between 6.4 and 6.8 days. That figure isn't just noise. It's an explicit indicator of deep structural illiquidity on the buy side. Any attempt by those shorts to cover is going to be messy.
And what we need to realize is that the foundational risk for FUBO has shifted entirely. They're no longer a struggling speculative asset just fighting for sheer survival. Through some pretty strategic maneuvering and, of course, the impetus of the successful antitrust litigation against the Venue Sports joint venture, FUBO has transformed. It's now a major player in a domestic vMVPD duopoly alongside YouTube TV. The existential threats are, for the most part, gone.
Okay, so I think the central question we have to tackle today is this. Has FUBO, now, intrinsically backed by Disney, successfully achieved a sustainable, profitable scale, what we might call asymmetric convergence, or has it merely exchanged its old solvency risk for crippling structural governance and margin constraints that will ultimately just limit any value appreciation for minority shareholders?
I see why you'd frame it that way, but I think the focus needs to be on the upside. My view is that the scale FUBO achieved, now commanding nearly 6 million subscribers, and the resulting synergies, they fully justify a significant market re-rating. The existential threat is replaced by what I'd call a protected utility status within Disney's massive portfolio, and that suggests the upside potential is far, far greater than the remaining downside.
And I'd argue that if you cut through all the talk about scale, the real story here is the governance. I think the price FUBO paid for survival was simply too high. It resulted in a business model that is structurally constrained by the never-ending escalation of content costs and fatally controlled by a majority shareholder, Disney, whose operational interests are, I believe, fundamentally misaligned with minority Class A investors.
Well, my position really just rests on the fact that FUBO successfully navigated what everyone calls the valley of death for streaming platforms. As you mentioned, they didn't get there through slow, organic profitability, but through strategic regulatory arbitrage, which led to the combination with Hulu Plus Live TV. The pro forma reality of this new FUBO entity is it's compelling. 6 million subscribers gives them massive scale efficiencies that fundamentally change their bargaining power.
But at what cost?
Well, let me finish. We're looking at serious guidance for 2026 revenue, between $6.5 and $7 billion. More critically, they're projecting an adjusted EBITDA of $325 to $375 million. That implies a massive swing from perpetual losses to a 5% margin profile. The primary alpha, the real source of added value here that justifies a re-rating is the integration of FUBO's very valuable ad inventory into Disney's far superior ad sales organization. That should drive significantly higher CPMs and fill rates. They bought stability and a clear path to profitability.
That's a compelling argument, and I recognize the sheer scale they've achieved is staggering. But have you considered the cost of that victory? The successful litigation and the merger came at the price of independence and, crucially, debilitating dilution for existing shareholders. We saw a dramatic expansion in the total shares outstanding. An increase of approximately 286.3% because of the equity issuances to the Disney and Hulu entities.
A necessary evil to achieve that scale.
Perhaps, but furthermore, the governance structure is fundamentally flawed for Class A shareholders. Disney now holds 70% of the equity, it retains effective control of the board, and the board is chaired by Andy Bird, a former Disney executive. This isn't a symbiotic partnership, it's effective control, and the fundamental long-term risk remains the dumb pipe theory. This theory posits that the VM-VMPG model, which FUBO now embodies, is structurally unprofitable because the rising variable cost of content, especially those exploding costs for premium sports rights, will always consume that projected 5% margin. It makes long-term value creation incredibly difficult for minority equity holders.
Okay, so let's start with that governance point, because you're right, it is the linchpin of the bear case. But I challenge the assumption of a total lack of operational agility.
But how can you, when decisions on content acquisition are fundamentally constrained by Disney's majority control? There is a palpable, embedded risk of a conflict of interest here, an inherent principal-agent problem. Disney could, and entirely rationally from their perspective, use FUBO as a mechanism to dump high-priced content rights like ESPN, ABC, or FX onto FUBO's balance sheet just to help subsidize their own core linear networks. This effectively transfers value away from FUBO's minority holders and straight into the Disney parent. We are already seeing evidence of this structural inequity in the governance documents themselves, such as the Tax Receivables Agreement, or TRA.
Right, the TRA, sorry to interrupt, but could you just quickly break that down for listeners who might not be familiar with those kinds of M&A instruments?
Yeah, of course. So when the merger happened, FUBO acquired assets that generated significant tax attributes like net operating losses. These are valuable because they reduce future tax burdens. The TRA is an agreement that basically ensures that 70% of the value generated by those future tax savings goes directly back to Disney, rather than remaining with the consolidated FUBO entity and benefiting all shareholders proportionally. It's a mechanism that structurally ensures Disney captures a disproportionate share of a specific future financial benefit. How can minority shareholders trust the board to act solely in FUBO's interest when the majority shareholder has such clear, conflicting financial motives?
Okay, but I'm not entirely convinced by that line of reasoning because while I acknowledge the governance structure creates a principal-agent problem that's unavoidable when you take on a 70% partner, you have to look at the powerful incentives of the leadership team to overcome that. David Gandler is still the CEO, and his entire compensation structure, roughly $8 million total, is heavily weighted towards equity performance. Over 50% of that, about $4.2 million, is in stock awards. He is incentivized to drive the share price up, not to see FUBO become some slow-growth utility.
But his hands are tied by the board.
Not necessarily. And we have to follow the money and be precise about insider transactions, which, often create unnecessary panic. There was that notable $434,000 share sale in January 2026. While that looks bearish on the surface, the regulatory filings clarified that sale was executed solely to cover tax obligations from RSU vesting under a prearranged 10b5-1 plan. Crucially, in that same period, Gandler acquired over 434,000 shares through RSU exercises. The net effect is a significant increase in his underlying exposure to the stock. Management is fully aligned with long-term equity performance, despite the constraints.
Look, the alignment is one thing, but the sheer physics of the share count is another. Let's talk about the valuation ceiling, or rather, the lack of immediate upward mobility. That valuation gap you and so many others cite, well, it's a mirage obscured by the scale of the dilution trap. We have to reiterate that the 286% increase in the share count fundamentally resets the per-share value calculation. Even if FUBO's overall enterprise value rises significantly, per-share appreciation is fundamentally constrained by that supply overhang. And I want to introduce the take under risk. Disney, with 70% control, is operating with a clear endgame, full integration. They will eventually take the company private at a modest premium, ensuring that any massive upside envisioned by Class A holders, the kind of upside that would justify that $40 billion YouTube TV comparison, is capped. Disney doesn't want a booming 10-bagger competitor in their portfolio. They want a consolidated, controllable utility. The interests of the minority shareholder are just diametrically opposed to Disney's structural objective.
I agree that the dilution number is staggering, but let's look at what that massive equity issuance actually bought them: survival and market dominance. You can't value a company strictly on dilution without valuing the assets acquired. And those assets, 6 million subscribers, provide significant leverage.
FUBO's current implied market cap is only, approximately $1.69 billion. If we look at the theoretical valuation of YouTube TV, often rumored around $40 billion, FUBO now has roughly 60% of YouTube TV's subscriber count, 6 million versus 9.4 million.
It's not a direct comparison, though.
It's not, but the difference is vast enough to signal a re-rating opportunity. And more pragmatically, that 6 million subscriber base provides vastly more leverage in content negotiations with critical partners like Paramount or NBC Universal. That leverage is compounded by a niche FUBO still dominates, regional sports networks or RSNs. YouTube TV has largely dropped these high-cost local networks. FUBO retains them, making FUBO the mandatory service for dedicated local sports fans. That gives them a protected competitive moat.
But FUBO cannot win the technical or feature war against Google. That's their true competitor. Google has virtually infinite capital. They own the operating system Android TV that many of these vMVPDs run on. And crucially, they control the most valuable sports asset in the U.S., NFL Sunday Ticket. FUBO is relegated to a distant, structurally inferior second place, which puts constant pressure on those razor-thin 5% margins you are projecting. They are in a content war with an entity that has superior tech, superior capital, and superior sports rights. That puts a definite ceiling on their valuation, well below the gap you suggest.
That's a comprehensive look at the fundamental constraints, but let's pivot back to the mechanics of that enormous short interest we opened with, because this is where the volatility potential really lies.
Okay, but I'd maintain that the short interest isn't just irrational retail speculation. It's highly rational, sophisticated money executing concrete strategies. Many funds are engaged in what we call stub trade hedging. This means they are long Disney stock and short FUBO stock. They're hedging the risk that the overall integration fails or that FUBO becomes a drag on Disney's core earnings. They're betting that FUBO, the smaller entity, the stub, will underperform the parent company. Others are simply executing that fundamental skepticism you mentioned, betting on the long-term failure of the thin-margin vMVPD profile. And while we discussed Gondler's tax-driven sales, the overall lack of open market, discretionary buying by individual insiders, distinct from those automated RSU grants, is a notable bearish signal. It suggests management views the stock as fairly valued right now, not deeply undervalued. That contradicts the valuation gap thesis.
I agree that complexity requires multiple perspectives to fully appreciate, but the structural illiquidity created by that short position is not just rational hedging. It is a powder keg waiting for a match. You yourself highlighted the high days to cover ratio, 6.4 plus days, and the fact that 59% of short selling occurs off exchange, typically in dark pools. Dark pool activity masks immediate selling pressure, but it also means that price discovery is opaque and volatile. When shorts are suddenly forced to cover, say if a major catalyst hits, they must access lit liquidity on the NYC. This structural illiquidity, combined with high call option concentration in the retail space, primes the stock for an explosive gamma squeeze.
And the catalyst is what exactly?
The catalyst here is clear and measurable: execution. If FUBO successfully hits that projected adjusted EBITDA target of $375 million for 2026, the bears will be forced to cover in mass. That validation of the consolidation thesis would drive a massive, sudden re-rating, because the liquidity is simply not there to absorb the forced buying pressure.
That requires perfect execution, which is a big ask under a constrained governance structure where their majority partner might be prioritizing their own linear network's content needs over FUBO's profitability. The 5% margin is just too narrow to absorb even small content cost shocks.
The fact remains, however, that the existential threat of going bankrupt is gone. They are profitable on a forward basis.
But the control risk is paramount. The equity upside is constrained by who is truly pulling the strings.
We have certainly covered a significant amount of complex ground regarding the new financial and structural profile of FUBO post-merger.
Absolutely. We successfully identified the core tension today. The advocate here sees a successful strategic pivot supported by compelling 2026 revenue projections between $6.5 and $7 billion, and the complete removal of the existential threat FUBO faced as an independent entity. This scale, leveraged by Disney's ad technology, provides the path to sustainable 5% margins and a substantial market re-rating.
While the dissenter sees a financially constrained entity where execution risks are amplified by the inherent conflict of interest stemming from Disney's 70% governance control. This, combined with the long-term fundamental unsustainability of the VMVPD thin margin model, ultimately traps and suppresses equity value for the now massively diluted minority shareholders.
FUBO stands today as a unique paradoxical equity, a successful consolidation play that is simultaneously a structurally constrained tracking stock. The key variable remains execution, specifically the seamless migration of that ad inventory to Disney's superior ad stack, and, critically, the rigorous management of those ever-rising sports content costs.
It is a true example of asymmetric convergence where the downside appears strategically capped by the Disney stake acting as a floor. But the upside potential is fundamentally contingent upon overcoming the immense structural hurdles of governance control and competitive pressures that we've discussed. The market is weighing the benefits of massive scale against the severe limitations of control and dilution, and it is up to the individual investor to determine where the balance of evidence lies.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.